Good to go. Good afternoon, good morning to everybody out there. This is the ninth in a series of Lunch and Learns that we've been doing for educational purposes for clients and stock nerds and market lovers and people that follow us out there. And today's topic is going to be on portfolio management, more in particular about selling and raising stops as your holdings progress. Let's start off with a reminder. So much content on our website at revereasset.com. Here is this is the contact us page of our website. You've got the daily market insight videos out there that Tim and I do 5 nights a week. We do podcasts on the weekend. And you're here because you signed up or you contacted us prior through this webinars link that we have out there. Let me also remind you, we're archiving these on YouTube. So if you go to YouTube and search for Revere Asset, you will see a list of all these lunch and learns. We're in the process of editing them and tightening them up so they're focused only on educational content. We want them to be evergreen so that they're not talking about the market that's 3-4 months old and stale. We want it to be focused, and a reminder that this is for educational purposes only. We're not advising that anybody buy or sell any stock or ETF or anything. We are a fee-only. Revere Asset Management is a fee-only registered investment advisor. We do manage money for a living, obviously. We provide this as a service, as I mentioned. And if you're interested, we also, what separates us from other asset managers is that we have a stop discipline, a sell discipline to avoid deep drawdowns should the market go south. That is clearly what separates us. We've got a rules-based for entering and exit the market. Want to remind you today, since you're attending live, you will be eligible. I'll draw a name afterwards. Everybody that attends live is eligible to win this this copy. It's about 175 pages, very in-depth, top stocks from 2018. Why do you care about top stocks from 2018? You care about the lessons learned from them, and it's how to identify big winners. And it's like looking for familiar faces in a photo album. They all have shared characteristics, and it's constantly where we're looking for. And this is today's door prize. So I will pick somebody at random from anybody that attends live, and I'll contact you via email if you want this. Maybe you still have it and you'd rather somebody else have it, but you will hear from me. So also, we're going to cut down on what's going on in the market, although we do continue to be in a nice uptrend. I want to refer you to last night's video for in-depth analysis. Nothing really changed from last night's video. I talked about how we gapped down, but we closed at the highs, and several things that I talked about in here as far as bulls were concerned. Yesterday, I noticed that although we were down, growth and momentum was strongly outperforming value stocks. Also, small caps were outperforming the larger. Those are risk-on type things. Tim also brought to my attention mid-morning that the put-call ratio was very high. That's a contrary indicator. And very often when it's high, you see lows put in the market. We didn't go any lower than the opening 30-minute range, and we added some exposure in-house yesterday, and it's paying off nicely today. In particular, AMD I added to my position. Let's look at the chart at that real quick. AMD, classic shakeout with the gap down open below the 21-day exponential moving average. When it came back above it, I took a position there, following through nicely today. This is something that I've held for over a month, rode this up, took some partial profits, came down, and following the rules, presented a nice secondary entry point with this bounce above the 21-day exponential moving average. So that's working out very well. So let's get to the meat and potatoes of what I'm talking about. Again, if you want to review everything I talked about in the market, go to last night's video. Today, we are focusing on portfolio management. I'm going to review certain assumptions and rules about where you should be in the market. And then we're going to talk about some offensive selling and some things that you want to take into consideration. And the primary thing that you want to take into consideration when selling something on the way up is how long has it been moving and what percent is it from a pivot or key moving averages. And then the typical selling where we set stops, you want to talk about the initial stops when you take your position and raising stops as it moves forward. And then finally, we'll wrap up with Q&A, and I'll take any charts on request. Again, we're trying to, prior lunch and learns have been about an hour long because they focus not only on what's going on in the market, but also the educational aspect of it. But we're trying to focus this. This should be about 30, at the most 45 minutes long. And again, if you want to know what's going on in the market, refer to last night's video. So let's get to the portfolio management, and let's start off with the assumptions and rules. So these are kind of the ground rules. This is what you have to accept, and it's what we accept as we add exposure into the market. And the first thing, of course, you want the market to be in an uptrend. If we're consolidating as part of an uptrend, that's fine too. But if you're in a consolidation, you don't want to be buying breakouts because they're very failure prone. At that point, you want to be buying pullbacks into support. Our process also identifies leading sectors and leading stocks, and you also want to know preferably growth is outperforming value because we are primarily a growth shop here. Those are the stocks that outperform during an uptrend. They've got certain characteristics, and the main two characteristics that I look for are relative strength and the N in William O'Neill's CAN-SLIM, the N being something new. You want to have some sort of a catalyst with that stock or with that sector for what's going on. You want to see strength in the sector that will trickle down into the stock, and that's how you get outperformance. So once you identify those stocks, you want to look for low-risk entry points. This meaning that, William O'Neill's rule that you never want to lose more than 7 to 8% on a stock. We modify that a little bit because we go by proper position sizing, which often allows us to take, sometimes we have to take a smaller size, but we widen our stop. Sometimes we can take a larger size with a smaller stop. It depends on how volatile the stock is. I'm going to talk about that when we get to managing downside risk. But the most important takeaway is that you have to obey price, not your emotions. It doesn't matter what you think about a stock. If you've got a certain thesis, it doesn't matter what you think about the economy. It doesn't matter what you think about what central banks are doing. The only thing that matters is the price and the price action of the stock or the ETF, or we don't pick mutual funds, but some people do. What's important is you obey the price, not what you think about the market. It's important that you obey what's actually going on. And this is the biggest takeaway from this is you've got to understand every time you buy something, there are 5 possible outcomes. It can turn into a big gain, and hats off to you if this is all you get. You're better than me if you do. And I don't think there's really anybody out there except for some people on Twitter who only talk about their big gainers. But that's obviously the best case scenario. You can also have something that goes a little bit, but then maybe the market turns or consolidates or something happens with the stock, and the best you can get out of it is a small gain. A lot of times you get out for near break even, maybe a 1 to 2% gain or a 1 to 2% loss. Sometimes it goes a little bit worse than that, and you'll have small losses again. Everything that I enter, I don't want to lose any more than 1/3 to 0.5% of the overall size of my portfolio. So that normally equates to, a position that's very manageable, and if something starts going wrong, it's a very small drawdown. Now, the 5th outcome is a big loss. This is when you let your emotions get the best of you, or sometimes you'll have bad news. Sometimes the stock will get a downgrade. Several reasons can happen, but you want to eliminate this at all possible from your portfolio. If you're just dealing with big or small gains, break-evens, or small losses, and you eliminate the possibility that you're ever going to have a big loss, and I'm going to call a big loss more than 1%, of the overall size of your portfolio, you eliminate those, you will drastically see your outcomes improving and your performance in the market, and you can really make a significant amount of money. But it involves a lot of limiting your emotions, putting your ego aside, and obeying price, proper position sizing, low risk entry points, and that's one of the big keys to being successful. So once we take an entry, we want to manage downside risk, and you've got to always be aware of two areas. The first one, and I focus on this, I'm a lot more active than some people. I'm less active than some people also, but I focus a lot on where is the 21-day exponential moving average. I use this as a short-term trend to identify where we are, and if you look at what I referenced in the background here with this AMD chart from yesterday, and you'll see that if you watch my videos, I always have the 21 over the 21 EMA list. I focus very heavily on the 21-day exponential moving average as a definer of what is short-term healthy versus what is short-term unhealthy. And then, but you always have to keep in mind when you own something, and this is proven over and over again, your risk is always to the 50-day moving average. That's the 50-day simple moving average. That's the red line on this chart. If you keep track of where your investments are relative to the 50-day, you can get an idea of what your downside worst case should always be. And let me bring in a spreadsheet that I want to use when hammering this point home. So what I have here is a list of holdings that we currently have in-house, and then above it, a comparison of some very common indexes and big stocks. So what this is going to show here is, here's the ticker symbol. This is the entry point. This is the initial stop that I created. And this is the percent stop loss based on my entry minus my exit. Then I want to know how big a size can I take in this, and I'm considering a maximum drawdown of 0.33% of the overall portfolio. This tells me in this column the size that I can take in my entry at worst case with this stop to hit 0.33%. I want to make sure everybody understands that. So what I'm doing is I want to know, based on how volatile the stock is, my maximum drawdown is going to be 0.33% of the overall portfolio. What size can I buy based on this entry and this stop? Now, two other things to factor in here. This is a very important column right here. This is the ATR, the average true range. I know Tim shows ATR charts all the time when he does his videos, but you have to take the ATR of the what you're buying, that's this column, and you divide it by the price. This gives you a percentage that you can expect this stock to move on a daily basis without on average. So for example, you have to understand how some things are way more volatile than other things, and it's not just a matter of what the beta is. So let's take, for example, one portfolio holding that we have right now is Costco. It's a slow mover. Its ATR is $3.63 a day. That's on average. Costco moves 1.24% on a daily basis. Now let's compare that with something that I also hold right now, Nugget. This is an ETF, but it's a 3 times gold miners ETF, and it's volatile. But with my entry that I just recently took, it told me I could take a 4.4% size. Worst case scenario, if my stop is hit, I'm only going to lose 1/3% of the overall portfolio. But the ATR of Nugget is $1.70. This moves 6% on a daily basis. Okay, my understanding, and I understand this, its beta is negative 1.35, so it actually moves inverse to what the overall market is doing. The point here is, and if you look right below it, Datadog is something that I'm also looking at, but Datadog has a 6.24% average move on a daily basis. You really need to limit your position sizing on that in order to lose the least amount of money when you're wrong. So that's a key takeaway. So when we buy something, we've got our entry price. We know where we're going to stop out at. We know what that stop percentage is from where we're buying, and we know how we can size it appropriately based on the fact that we only want to lose 1/3%. So let's say something with Costco that moves that much. Suppose we want to bump this up to 0.5%. 0.5% instead of 1/3%. This increased the position size that we could have taken to 9.3%, and we understand that the ATR percent is it only moves 1.24% on a daily basis. So this could go down 7 straight days, 1.24%. That's still not out of the ordinary. And worst case scenario, our stop, we only would have lost 0.5% of the overall portfolio. Again, I still like to limit it to 1/3, and it's really your preference. A lot of times traders want to take larger positions, and they make this a full percent, and they'll take a larger position size and just let it go. But to limit portfolio volatility, this is pretty much what I stick with. So moving on from that, so we've got our initial stop set. We understand where the 21 EMA is. We understand that risk is always to the 50%, to the 50-day moving average if a harsh sell-off should happen. And let's take a look at an example for that. STNE, this is a stock that was on my watch list. I don't own it, but it had a great reaction to earnings. Went sideways a little bit. This is something I very easily could have purchased. It's got good fundamentals. But then the market went south Friday and Monday. So knowing that my downside was to the 50-day moving average, if I would have taken an entry here, that's 17.8% all the way down to the 50-day moving average. You have to understand when you buy something and things start to get shaken out, a lot of people set their stops right around this 50-day moving average. The algorithms will come and collect those stops. Look how it stopped at the 21 the first day. A lot of people put their stops there. And then the second day all the way down to the 50 before it rebounded along with the market. You have to understand when you buy something that your risk, even though you've got your stop set higher, it can very quickly go all the way down to the 50-day moving average during a market sell-off. So let's get now down to the offensive selling, time and percent from pivot, and moving averages. So let's take a look at something that was bought at the beginning of this most recent run-up. This is Vertex. They announced that they got FDA approval for increased labeling of their cystic fibrosis drug. This is estimated 6.67%, $6.67 that they can earn in 2020. This has the potential to actually double based on some research that I did, so I felt very confident taking a position on this gap up. It was still inside the base. Let's go back to the spreadsheet that I had here when I bought it. Vertex, 189.80. My stop was at 182, so worst case, I was going down to 3.86% and allowed me to take a bigger position size, 8.5% on it. My stop being calculated as, if you look at my last video on rules for gaps, I go over this extensively. 2% below the low of the day is how I set the stop. This stock acted beautifully, just like how I wanted it to, continuing to move higher, broke out of the base. You've got volume here as it came through the pivot, pulled back very controlled on lighter volume into the ADMA. This is another great place to either take your first position if you missed it the first time or add to it right there. And then it just got a little bit extended, and I took half of this off the table last week when it went all the way up here and it got to where it was 18% above the 50-day moving average, 9% above the 21-day exponential moving average. I just took half off. The market was very extended. This is just a case of offensive selling, adjusting stops on the way up. Notice how this has obeyed the 8-day. This is this purple line on here. It has obeyed the 8-day exponential moving average the entire time of this run, and this is very typical of how strong growth stocks act during a bull market. If it breaks below the ADMA, noticed it held it twice over the last couple of days. That's a change in character on this stock based on the move up that it's had since it had its breakout, and it can very easily pull back all the way to the 21-day exponential moving average. That's now 4.9% away. Ideally, this will go sideways for a little while. The 21-day would catch up to it. It would tap it again, and that would be a great way to get back to my full position size on this. Right now, I've got about a 5.5%. The initial purchase got up to over 10%, and it just got a little bit too extended. So I did some offensive selling and took some profits off, booked some profits on it, and move it into other stocks that are presenting more low risk entries. So that's an example of offensive selling. Now let's talk about defensive selling, initial stops and raising stops. Let's take a look at AMD for this. AMD, the initial buy, let's go back to the spreadsheet that I had here. AMD, I initially bought this at 33.33 on 10/31. So let's take a look at the chart here. 10/31. AMD, notice the relative strength and the N. AMD just came out with an announcement, and they got a couple of upgrades on their new chips that were being released. The market, this is the black line. This is the market here. We had a correction here. We had a little bit more of a correction here. AMD corrected along with the market, but it came out of it very strongly. I'm always looking at relative strength. So it went up sharply, had a couple-day pullback here, bounced off the ADMA. I bought it here on 10/31 at 33.33 when it got back above the most recent high before that little wiggle. So 33.33 was the initial entry. Then it broke out above again on volume. Look at the volume down here, how it's above average as this is making its move up. This stock is being accumulated. You've got the relative strength working. I added to it on this pullback off of the ADMA, so now I have a full 10% position on this. And this is another situation to where I'm keeping my stops in place as it goes up. So if I would have broken the ADMA and it would have made a character change, I would have gotten out of it. In this case, I was fortunate enough to take some off here, again, as it made this very quick run up over the last couple of days. It's just telling you that you're going to have a pullback. So I did, again, some offensive selling, but defensively, my stop was set here to take half off. It would have broken below the ADMA. I just decided to do the offensive selling instead. So now yesterday, very similar to what I'm looking at in the example with Vertex, I want to buy if it comes back into the 21-day exponential moving average. So at this point, my mental stop for the remaining half is a couple of percent below this 21-day exponential moving average. Also looking at the fact that right here, it's got a lot of support before it broke out and really went on this run. So once it survived this breakout below the 21-day exponential moving average and got back above it, if it would have continued going lower, I'd have done some defensive selling and got out of the remaining half position if the market would have corrected and gotten worse, but it didn't. It bounced. I added my second half back yesterday, and it's following through to the upside today. So you can go between offensive and defensive selling based on what's going on with the stock and where it is relative to its pivot point and its moving averages. So as this works its way up, I've got a separate spreadsheet, and maybe this is something I'll talk about on the next lunch and learn that we do, some of the math behind this, but I keep track of this for all of the holdings that I have, so I'm always aware of what the maximum drawdown is going to be to the portfolio. The idea with portfolio management is that you get a slow, steady increase and work your balance to the upside, and then when all your stops are hit or the market turns south, the market takes you out. You don't make a decision based on emotions. You make it based on the fact that your stocks stop acting the way they were. The market stops acting the way it has. And very much this was on display the fourth quarter, particularly in December. Markets don't really tend to get totally unhealthy unless something breaks below this black line, and that's the 200-day moving average. So all of our videos are out there. It's documented how we were reducing our position size as we broke the 200-day moving average. We popped this again. This is the S&P 500 last December. We got back above it for one day, broke back below it, and then December was a really bad month, down over 9%. So the distance between where the indexes are versus their 200-day moving average, that should give you an idea of approximately where your drawdown is going to be from your portfolio balance right now. So right now you can see the S&P 500 is 6.2% above its 200-day moving average. The more aggressive NASDAQ 100 is 7.8% above its 200-day moving average. So kind of the way I keep track of everything, this kind of coincides with what my maximum drawdown is going to be from where my equity is versus where we are on the 200-day moving average before all of my stops get hit. And that's pretty much the maximum drawdown that I'm looking at. So right now this would be about 7.9% on the NASDAQ 100, and that's a heck of a lot better than the 20% drawdown that you saw in the indexes. Actually, the NASDAQ was down 28% in the fourth quarter of last year, but all of the indexes corrected between 20 and 28%. We've got it documented out here on video on our website for what all of the selling that we did during the fourth quarter, and then how we got back in during January of this year. And the important thing to keep in mind about all of these rules that I just talked about, it's not about how much you make in the market, it's about how much you keep. This first lesson was hit home to me when I first really started seriously investing and trading stocks back in 1999 to 2002, where I doubled my money in a short period of time and then gave it all away as the tech bubble burst. And that's what really started me on this quest to understand when every other part of my life starts going, if something starts going negatively, like say it's going to rain, I take an umbrella. If the check engine soon light comes on in the car, I take it in for service. But why, when your portfolio starts going south, do you not take action? It's because Wall Street has brainwashed people into keeping their money in the market so they can collect their fees on the mutual funds or what you are invested in. But it's not about how much you make in the market, it's about how much you keep. And the quest to limit my drawdowns led me to the William O'Neill rules, and to really help get out of the way when when the financial crisis came. Totally dodged that, while I saw a lot of people really get devastated about it. And that's really what we're about at Revere here, is participating in uptrends. And the market is certainly in an uptrend now, and we're near fully invested, but getting out of the way when the trend turns negative. And that's about going to wrap up the education section on portfolio management. So now it's time for Q&A and charts on request. If you have any questions, just type them in on your dashboard. You should see a questions option. Type your question in, and I'll take them one at a time. And I've got a couple of them already, so let's take a look at them now. So the first one is, could you please explain what the pivot point is? The pivot point is, let's go to Vertex. The pivot point is all stocks undergo consolidations at some point. And you can see with Vertex here, the dotted green lines, this is basically a 193-day long flat base where it corrected 16%. The pivot point is when it goes through the top of this base, and basically that's called a breakout. When they happen in uptrending markets, you can see the black line here that the market had resumed its uptrend. This is what the S&P 500 is doing. The pivot point is the point at which you break above a prior high. Now, there are many different ways of calculating what your pivot point is. In particular, I was looking at this 188.44 level on here, and when we gapped above it, that was what I used to trigger that. And the fact that the volume was huge, you can see 293% above average volume, was up 4% on the day. And it was a leader. It has good fundamentals. You can see the growth rates over here on earnings. It has a highly rated group. So it's a matter of the fundamentals and the technicals coming together. You compare it to your pivot point. Pivot point is really the point of least resistance where once the stock goes higher, it can be off to the races. So that's the situation. That's how you define a pivot point. Next question, will you sell Vertex if it breaks the 8 EMA or let it go to the 21 EMA? Because I have a half position, I would give this down to the 21-day exponential moving average, which is only 5% away from where it is right now. So if I have a full position, a change in character in this case would have been a break below the 8 EMA. That's where I would have gotten a defensive selling of half of it. Right now I did offensive selling to get out of it, and I'm looking to add the other half back, but I wouldn't do it unless it bounced off of the 21-day exponential moving average. If it goes sideways and forms what's called a 3 weeks tight and then breaks above this area here, which is approximately 223.61, I may add the second half back on strength because the market is acting well. Biotechs are a very strong group, but I would want to see this go sideways for 3 weeks, so about another week and a half. And if it breaks above there, the exponential moving averages will catch up to it. The 21 would catch up to it. And basically, this would be another breakout of a consolidation, a 3 weeks tight. I know you've heard Tim and I talk about these a lot, but this would be another way to get the other half back. So it would either be on a pullback to the 21 or a breakout above a 3 weeks tight. Next question. So the pivot point is a definitive change in character or price action. Yeah, that's one way of looking at it. It's a point of resistance that a stock hadn't been able to get through, but now it does get through. This software package that I'm using, MarketSmith, does a lot of the work for you. But also, if you're an experienced chart reader, you can calculate alternate pivot points versus what it does. Next question, can we look at a daily and weekly of CMG and Amazon? Sure. CMG, this is something we own in our stock and ETF portfolio, and this is an example of buying on weakness into support. CMG was a leading stock. We took advantage of this and made money on this, sold when it broke harshly here. Then it started to consolidate. On its last earnings report, it had a gap down. So now if you look at the gap rules that I just did the prior one on, the low of that day is a key area. So is the high of that day. So in this case, it was a mild gap down that later broke the low. So this is a sell or an avoid until it comes into a proper support area. In this case, the 200-day moving average was the support area. We bought it here, very low risk entry on a very quality stock. And it's been working out very nicely for us as it creeps higher. See, it got above the 50-day moving average and the round number 800 level, which is just absolutely fantastic. This is doing exactly what we wanted it to do. We've got a 12% gain on this versus the market only being up a couple of percent since then. You can see the relative strength cooperating. I can't talk about how important relative strength is. I can't talk about that enough. And now it's going sideways here. Very bullish, going sideways. I would expect you're going to see the 21, which is the green line, come up through the 50. That's also a big help. So you've got 3 levels of support here. You've got the round number support at 800. You've got the 50-day moving average at 795. And you've got the 21-day exponential moving average right now at 788, but it's getting ready to come up through there. I would expect that those hold it as long as the market stays fine. This is actually a low-risk spot to enter. With a stop below the 21-day exponential moving average. Also request to look at Amazon. Amazon has been a laggard ever since 2 earnings reports ago where it gapped down. And again, following the gap rules that I just did, this was a mild gap down. You then look at the low and the high of this to see what the next direction is. It only took a day for it to break. Came all the way down, and for a while it held the 200-day moving average. We haven't held Amazon for a while. Finally, it broke the 200-day moving average, and 3 attempts now to get back above it have all been acting as resistance and unable to get back above it. Now look at the relative strength line. That's this blue line here, about how weak it's been with Amazon while the market is trending higher. I understand Amazon's a big stock if you don't own it. there's no real reason to be in it here. I would wait for it to break above and stay above this 200-day moving average here, right above 1800. The 200 is still trending above, which is still trending slightly higher, which is a positive. And the stock is also hanging right here around three moving averages: the red line, the 50, the green line, the 21, the purple line, the 8. You really do not want to see this break below. If you're still holding it, you really don't want to see it break below yesterday's low. And worst case, if you still own it, you really don't want to see it break below this low of a couple of months ago, which was 1685. So yes, relative strength improved for about a week and a half as it made its way up. I think this was just people piling in anticipation of Black Friday sales. Amazon seems to make a run into Black Friday every year, but you can see it hit the 200-day moving average and then reversed lower. So right now, Amazon is not a healthy stock. Let's see other questions. I'm looking at a long entry on Roku. It bounced off the 50-day and is now above the 21. I'm also looking for a long entry in Roku, but this has been a bucking bronco lately. And this was a big downgrade. This moved down. So this was, again, following my gap rules. The high and the low of this gap day tell you what the next move is. It very healthy. The lowest risk entry in this case would have been here where it held the 50-day moving average, and now today it's back above the 21. 150 is considered a round number to me. You can see how it struggled with 150 here, blew right through it as it was on this big run, gapped below it. I'm not in it here. I'm waiting for it to calm down a little bit. I do like that it bounced off the 50-day moving average. Any entry, it's now 11% above the 50-day moving average. So any entry here, you've got 11% down, and even more, probably 12 or 13%, if it would break below the low of 3 days ago. You just got to understand, and just position size accordingly. You can buy anything as long as you've got a proper stop and you're position sized accordingly. This is kind of in no man's land here. I want to see it calm down a little bit, maybe go sideways for a week or so before it would break above 150. This would bring the 50-day moving average up a little bit closer to it, but still, so you've got to understand what your recent low is. Your recent low here is 132.40 on this panic sell. It certainly could revisit that again if the market turns south or if another downgrade on Roku comes out. What would the max above pivot that you would buy on a 3-week tight? I never buy more than 5% above the pivot. If you do that, then you're chasing. So I like to get it within 1 to 2% of the top of any breakout. The exception would be if something would gap strongly on earnings, such as Roku did here, and then it's a whole different set of rules. And again, refer to my prior video on gaps about how you play something like this. It's very difficult from a mindset standpoint to buy something when it gaps up 21%, but if you did, look how you were rewarded on this. But and again, if you do, should not break more than 1 to 2% below the low of the gap up day. So I covered this extensively in the last Lunch and Learn, which has by far been the most popular of all the ones that we've done. Let's see. Curious about how you screen for potential purposes. Do you incorporate the 21 or other indicators in the screening process? You have to know the market. You have to know the leaders. Investors.com and MarketSmith do a good job of giving stock ideas. I keep a list called the 21 over 21, which is really my main watch list. I curate it over the weekend, and I go into every week with a list of 21 stocks that are healthy, and I'm either in them or I'm looking for a way to get in them. And that's my universe. I'm looking for the lowest risk entries, and then I just let my rules dictate buying and selling and position sizing and stop losses. Next question, any thoughts on golds, bond, or XME? Let's take a look at GLD. I'm in Nugget, so let's take a look at Nugget first of all. I bought this last Friday, and I bought it because I noticed strength in several gold stocks, relative strength in them, particularly PAAS. This is a silver stock. look at the relative strength on it, and it broke out last Friday, but actually last Thursday here. This led me to start looking at some other ones. Franco-Nevada is one that's also strong. I tried to gap out and failed yesterday. This is a case of the market being weak. Gold stocks lately have been acting contrary to what the market's doing. So if market's up, gold stocks are down, and vice versa. But GLD itself is in a nice consolidation, needs to hold, as long as it holds below the low of this 136.19. I want to see it get back above this 140 area, which is the 50-day moving average. But for a while it held 140, broke below it on 11.7. We still hold GLD for a lot of clients with a very small, like maybe 2% loss, worst case. And we also own it in our asset class allocation portfolios. But right now, want to see it get back above 140 for it to be bullish. Break below 136.19 is a sell. TLT, let's talk about bonds. TLT has been very volatile lately. It's also been acting completely opposite to what the KBE, the bank index, is doing. If the TLT is down, KBE is up, and vice versa. You can see KBE is up today. I can guarantee you TLT is down. Yes, it is. You can see how they've been acting opposite each other for the most part. TLT is forming a base. It's a double bottom base with a 146.03 pivot, and a break below 134 would be a failure of that base. But right now it's just moving sideways. I'm kind of neutral on these. We do own TLT for quite a few clients because it's acting as a proper hedge during volatile times. Let's see, Don, are all these quantitative rules about portfolio size created by you, or are you following a methodology created by Investors Business Daily? The overriding methodology of Investors Business Daily is this: identify the market trend, identify the leading sectors and leading stocks, buy them at proper points, cut your losses. Those are the four major rules. And I absolutely obey them. All of the quantitative things that I've talked about are my touches, such as varying position sizing based on ATR. You rarely hear, in fact, I don't think I've ever heard Investors Business Daily talk about position sizing based on the average true range of a stock, but it's something I absolutely embrace. And a lot of the quantitative things I've done as far as position sizing, watching what the ATR percentage is, and obeying different moving averages are a lot of my personal touches that I've put on the overarching approach, which is identify the strongest stocks and the strongest sectors during a bull market. But as far as the portfolio management and loss management and risk management, those are all rules that I've created. And let's see, we're at 1244. That is going to, well, we got a real-time alert. Let's take a look at this. Boot is a stock that's on the 21/21 list. Pulled back with the market. Ultimate risk, always to the 50-day moving average. It bounced off the 50-day, and it's back in my good graces because it's back above the 21-day exponential moving average. It's in an A-rated group, has a PE of 25 and a growth rate of 30 for 2020. So anytime you see a PEG ratio, that's price earnings to growth, so 25 divided by 30 is less than 1. I love seeing that in growth stocks. Boot made a nice run along with the market. Had this is one of the types of inflection points that I talk about in the GAP seminar. It broke out above it, never broke below it, never broke below the 50-day moving average. This stock is a hold or a buy. And we're at 1245, so I am going to wrap things up. Thank you all very much for attending. Everybody that attended live, I'll contact the person that gets the Top Stocks book, and everybody will get an archive of this recording. The next Lunch and Learn is going to be 2 weeks from today, and I think I'm going to do it on some of the more quantitative. You know what? Send me some feedback on this. Type into if that's something you would be interested in, either type it into the questions or shoot me an email. Sometimes the math people are just not interested in the details of the math of calculating some of the things, but I'd be glad to share some of the spreadsheets that I use. I looked at my position sizing one today. I can share the balance at risk one that I use. And if that's something you'd be interested in, type it into the questions. But we're going to wrap things up. Thank you very much for attending. Be on the lookout for your copy of the archive, and have a great day, everybody. The market is up 0.6%, so we're seeing the usual, refer to last night's video for a more in-depth look. Gold and bonds are down while the market is rallying. That's consistent with what we've been seeing lately, and leading stocks are acting just fine. Thanks, everybody.